This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the AIPIS show for accredited income property investment specialists and those who aspire to be. If you're a real estate, mortgage, or financial professional, this is the place for you. We'll explore innovative investment analysis, sales, marketing, and income-generating strategies for the most historically proven wealth creator, income property. Learn from the experts as they show you how to build a better business and a better life.
It's my pleasure to welcome Andrew Rybczynski to the show. He is a senior consultant at CoStar Portfolio Strategy, and we're going to talk about housing today. Andrew, welcome. How are you?
Not bad, Jason. Thanks for having me. Good
to have you. So a lot of stuff has been going on in the crazy, possibly very frothy real estate market coming out of the Great Recession. Institutional investors, there's just a lot of money sloshing around looking for yield. We've seen a lot of construction in brand new A-class multifamily housing all around the country. It feels like every city I go to, there's cranes everywhere, right? Is that subsiding, or how's the supply-demand outlook?
So we certainly have seen a lot of construction of top-end apartment buildings this cycle, and your feeling on a lot of cranes in the sky is well-placed. Right now, we actually have the largest number of units under construction this cycle, topping out about 650,000 units under construction right now. Now, that's actually kind of an interesting subset of the market in that while we do have a ton of units under construction right now, units completing has actually not really been reflecting that. So the number of units that completed in 2018 was actually down a little bit from the number that completed in 2017, and 2019 isn't off to a great start either. This has affected vacancy, top-line vacancy, and we're talking in early April, so our Q1 preliminary numbers for 2019 are just out. And top-line vacancy in apartment is actually down a little bit from last quarter, and compared to where it was last year, it's actually down quite a bit. A lot of that is due to slower completions of apartment units, especially in that luxury market.
So why are those completions and deliveries slower? I know that developers in any part of the marketplace, no matter what they're building, there's definitely a labor shortage. Construction materials are always an issue. What's slowing the delivery, or maybe even talk about the financing end too?
So as best we can tell, the labor market is the key driver of this slowdown in delivery. Now, that's not true everywhere. I've heard anecdotal evidence that one of the major slowdowns in Boston is actually materials related. They can't get enough glass for curtain walls on high-rise apartment buildings. Mm-hmm. But even that plays into a labor shortage. We're at 3.8 unemployment right now, and the participation rate continues to rise in 25 to 54-year-olds. So we're really tapping the bottom of the employment barrel right now. Wage rises have started to reflect that, but the end effect is that it doesn't seem that there's enough workers to go around to build all of these buildings that developers continue to start. And that has had an effect in the length of time that it takes to complete a building. We have noticed an increase in the number of buildings that are taking 3 years or longer to complete. So speaking to the financing aspect of your question, that does mean that typically with a construction loan lasting about 3 years, you do have to go back and find some new financing.
Yeah, so you mentioned, you're located in Boston, and you mentioned, glass curtain walls on high-rise buildings, but a lot of stuff is just garden style, sticks and bricks type thing. 3 years to build high rises like that isn't, it's long, but it's not crazy, I guess. But the garden style stuff goes up a lot faster. So how is it in that sector?
That's true. And when I cited that rise, I was speaking specifically to garden and mid-rise apartment. Well, I shouldn't say garden because gardens, there's virtually no garden under construction. But the mid-rise sector is really what we look at when we're looking at those increase in number of buildings taking longer than 3 years to complete, because that is more likely to have a 3-year construction loan attached to it.
Sure. Okay, good. So those construction loans come due and, they've got to complete and they've got to deliver. Are your clients and, the research you're doing, they must be seeing big increases in construction materials costs. You mentioned the glass shortage. Anything else on that?
Well, we know copper and steel have both risen in recent years. Steel may be coming back in a little bit, but certainly tariffs have bitten on that front.
On the demand side, the renter demand side, or tenant supply side, depending on how you want to look at it, I guess, we've seen these interesting trends. It doesn't seem to be that there's much stigma at all toward renting anymore. It's not like you're a loser if you're a renter, but that used to be a little bit of the way people thought of it. The point is to be a homeowner, right? That's always the goal. But nowadays, I don't know if that lives like it used to, that American dream concept, and feel free to comment on that. But one of the things that's particularly interesting about the renter population is this baby boomer renter population. I mean, that's a new one, right? That we see baby boomers selling their houses, empty nesting, and then moving into apartments. And then if you segment the market, you talked about the high-end, high-rise apartments, which are always high-end. Maybe talk about the different categories of renters out there. And then I want to talk about your comment off-air about the, people moving down market, the buyers.
So the recession hit everyone hard, and home ownership rates peaked in around 2005. Since then, as you mentioned, baby boomers have started shifting towards renting more so than one would expect for that age group. That's been an important aspect of demand, especially for the high-end apartments that we were talking about. Downtown living appeals to not just the younger renter, but the empty nester, as you said. I can't speak to the mentality of whether a renter prefers renting or homeowning or any stigma that might be attached to it, but I can tell you that for younger cohorts who are owning homes at slightly higher shares than they had in the past couple of years, we've seen an uptick there. But for younger cohorts, there is still a huge problem of affordability and debt, especially in the older, more educated markets, Boston's and San Francisco's and New York's of the world, where not only do you have to pay that mortgage, but scrape together a tremendous down payment. And in many cases, you're doing that while you are neck high in student debt. The student debt story has attracted a lot of attention, but it's a very important aspect of the home ownership market.
Yeah, as I always say, we've got an entire generation of millennials who have a mortgage, but they didn't get a house included with it. It's called a student loan.
That's an excellent way to put it.
And that is an unbelievable scam. The price of college is a total scam. But that's another discussion. So, yeah. What else do you want to say about the supply of renters, the tenant population?
By and large, we do think that there's still a pretty good demand pool for renters. There is still a fairly large share of young people who live at home, and that's
sort of the shadow demand, right? And during the Great Recession, we talked a lot about the shadow supply of all these houses that the lenders weren't foreclosing on because they were just doing workouts or just postponing foreclosure, or they already had them in their REO portfolio. They didn't want to dump them on the market in fear of hurting the market too much, and the government had a lot to say about that too. But now, I mean, it's diminishing a little bit, I guess, as people do move out of their house, but there's this shadow demand of renters. So, that's interesting on that side of the equation that, living at home and 40 years old, I mean, or 29, that's unusual too, right?
It is.
Yeah.
But aside from that, we have seen very strong household formation over the past few years to the point where it's actually keeping up with supply to a large degree. And some of that comes back to the fact that we're just not building, especially single-family homes, as much as we used to. When you compare the number of single-family homes completing this cycle versus last cycle, there's a tremendous disconnect, and population growth hasn't fallen off as much as home building has. So we are essentially facing a housing crisis in America.
When you say crisis, you mean shortage, right?
Shortage,
yeah,
I should say.
Right. Single-family investors, make sure you heard that, because it is definitely true. The inventory coming out of the Great Recession, especially on the low end, these nice bread and butter type rental properties that, all investors love, there is a giant shortage of them. that bodes really well for your future in single-family home investing. I just want to make sure our single-family people hear that. Yeah, go ahead.
To that point, actually, the governor of California recently sued Huntington Beach for not fulfilling its construction.
I saw that, yeah.
Yeah, so there may be a backlash coming against this extreme zoning rules that prevent the single-family housing.
As there should be.
From being
yes.
built.
Yeah.
But for the time being, there is something of a housing shortage in America. And for an investor in multifamily housing, that's a good thing.
Yeah, no question about it. And an investor in single-family housing, too. That means we've got a limited supply. We've got a population that needs a place to live. And we've got this shadow inventory. Do you have any stats or information on that shadow demand? I said shadow inventory. I meant shadow demand. In other words, the millennials usually living at home that will move into the housing market and have household formation. You said that the household formation's been pretty strong. The only thing I would love to see is, something that would answer the question, compared to what? And here's what I mean by that. The millennial generation, that cohort, is so large, about 80 million people, that, even if as a percentage, like on a per capita basis, they're not moving into the housing market and doing household formation too much, and they're, living at home type thing, just because their numbers are so large, it's going to seem strong, right? Compared to my generation, Gen X, it's only 46 million people. I mean, we're like half the size. We're a tiny little generation or cohort. So do you have any thoughts on the percentage of the millennials or a comparison on that? I haven't seen much on that. I don't know if you do. Yeah, I don't.
I can tell you that last year in 2018 Q4, about 32% of young adults 18 to 34 were living at home, and compare that to let's say when your generation might have been in that age group, let's say 1990, that was about 28%.
Yeah,
a 4 percentage point jump maybe doesn't sound like a lot,
it's
but
a lot.
In terms of the raw numbers, we're looking at, let's say, in 1990, you had about 18.5 million young adults living at home versus over 23.5 today.
Yeah, and the funny thing is, there's really very little stigma attached to that anymore. Whereas in my era, and certainly the era before me, the baby boomers, that would have been just not cool to be living with mom and dad. You want to get out as soon as you can and be independent. And now, it's, and the millennials like their parents, a lot more than we did. So, yeah. No disrespect to parents, but it's just kind of a different mentality. It really is. It's very interesting. And society is so much more portable nowadays. And there's so much more travel going on that even if you do live at home, it doesn't really feel like you're as stuck there. So there's a lot of factors at play. Before we let you go, let's talk about the segments of, you deal with a lot of institutional buyers. They're not buying as much Class A stuff now as they used to, right? Because it's become pretty expensive. And you mentioned off air before how they were going down market and buying some of the B and C product, how that's pushing up the prices in that sector, right?
That's definitely been a trend we've seen in the last 4 or 5 years. So core pricing, that is pricing of your A-plus product in downtowns and core metros, has been pretty heady for the last few years. And a lot of institutional investors, the same as any other investor, have yields that they need to hit. So they have been traveling down market to some degree. And a good example of that is the Prudential insurance deal that got done a few months ago. They bought about $1 billion worth of workforce housing, that is B and C properties. The yields on those B and C properties tend to be much healthier than your Class A stuff. And furthermore, one thing that we've noticed, especially for investors who are really seeking some additional boost to yield by going to value-add properties, that is properties that are a little more poorly occupied. You do some work, you bring the occupancy up, you get your yields, you get your IRRs a little stronger. Those poorly occupied buildings have the spread between a poorly occupied building and a well-occupied building in terms of pricing has come in a tremendous amount over the past 4 years. So someone looking to do that value-add prospect is now going to have to expect a little bit lower additional yield because you've got investors moving down the spectrum a good amount.
Yeah, that's an interesting trend. It certainly is. Any data you want to share on cap rate expectations on the different product segments? I mean, it depends on the city, obviously, but
it does.
Just anything generally.
But in general, our view right now is not terribly negative on cap rates. The spread between cap rates and BBB bonds, which we find to be a pretty good indicator, is actually pretty normal. And it doesn't feel normal, right? Because you're dealing with very low cap rates relative to history. But you have to look at where everything else is priced to history. The spread between an apartment cap and a BBB bond is pretty normal. So even though you might be looking at if you're an institutional investor, you might be looking at a 4.5 cap, that's still a pretty decent spread over a BBB bond.
Yeah, interesting. So that's a common metric that is compared, like, the institution could just do BBB bonds, or they could buy an apartment complex. And that's how they think of that, huh?
Yeah, that's a pretty typical comparison. It's especially useful in office because in office, if you're buying a top-rated office building, you're often buying a credit tenant. Doing the comparison between a credit tenant and a credit bond is pretty indicative.
Yeah, that makes sense. And, with a bunch of individual tenants in apartment buildings, it's different. But kind of curious, though, why do they compare it with BBB rated bonds? Where did that come from? Like, there must be some comparison on the way the investment's going to go and the risk associated with it is they're sort of taking, hey, look, we can buy this 200 unit apartment complex and it's about the same risk level as BBB bonds. What's the thinking there?
It has to do with the risk spectrum, the view on risk. So during a bad cycle, you'll get a lot of investors rushing into what's perceived as the risk-free rate, that is the 10-year bond. But they'll abandon what is perceived as riskier investments, that is BBBs and real estate. Real estate can go to empty very quickly, if perhaps not multifamily, but if you're dealing with a company that...
If it's office or retail, yeah.
Yeah, you can very quickly go to no cash flow. So that's where that comparison comes from. It doesn't hold up exactly the same with multifamily, but certainly multifamily also suffers in a downturn more so than the so-called risk-free rate.
Mm-hmm. Yeah, very interesting. I've been saying for a while, and I keep sort of moving my prediction forward. And, here's what I've been saying. The next 10 years, the demographics coming at the rental housing market are phenomenal. And, for all these reasons, student loan debt and the portable, no one talks about the portable society like I do, it seems like. But I think that is a factor that people don't consider themselves, they just need a kind of a place to sleep, right? They consider themselves much more portable. They can live in smaller units because all of our products have become so much smaller, In the old days, if you had a stereo system, you had these big, huge speakers. This actually matters. I mean, I don't know. It may seem like a dumb little thing, but I think it does matter, this portable society concept. I think people just view it differently. And so we've got all these different factors. We've got Gen Y coming up, and, it'll be sort of interesting to see what they're like. None of us really completely know yet how they'll act in the marketplace. But, is that still true? Do you think that the next 10 years of demographics coming at the rental housing market are really, really bullish?
Well, I've got a couple things to say there. So first, in terms of raw numbers, yes, let's call them Gen Z for now.
Or sorry, Gen Z. Yeah, Gen Y is millennial. Yeah.
Right. Yeah. Who can keep it straight?
Yeah.
But Gen Z in raw terms is just as big as millennials, and may in fact become bigger depending on immigration rules that may or may not come into effect. But that aside, many of the things that you were talking about, particularly as it pertains to smaller units, kind of different living styles, I think a lot of that is driven as much by preference as by the raw economics of the situation. We talked about millennials being burdened by debt, not necessarily earning as highly as boomers did relative to where standard median wage was 30 or 40 years ago. And I think that matters and has caused some of this, in effect, downgrading in lifestyles. Further, developers are always going to be looking for the best return on their assets, right? So shrinking unit sizes very much aids them as well. You get a higher price per square foot on a smaller studio than you do on a, certainly compared to a 3-bedroom unit. And kind of just my last thought on that was that when it comes to that whole portable lifestyle, I think that you're by and large right there. But one important statistic is that millennials have actually been less prone to migration than boomers were as a percentage of population.
I want to hear what you say about that, but I just want to interject. I would argue that they don't have the money to move. Now, I've always said the best thing you can have on a resume is mobility, to be able to go to where the jobs are. But yes, I think there's a certain aspect of just the economic ability to move, number one, and maybe, another factor is just kind of some laziness. I complain about millennials a bit, but yeah, go ahead.
So that does speak to what I was saying, that millennials have proved less likely to move either for jobs or for opportunity than boomers. Why that is, I guess I couldn't fully say.
Yeah. Well, comfort level maybe is sort of ties in with the kind of laziness. Just being comfortable. I mean, there's nothing wrong with that. I have this one client that says, you got to stop bashing millennials. I'm not really bashing them. I mean, listen, my generation's got tons of problems too. Okay, so Right. There's just not 80 million of them to talk about as they're moving through the economy. So millennials are just going to get more press. That's the way it goes.
Yeah, we're leaning on Gen Y to pick some of that up.
Yeah, they'll pick it up in a few years. So don't worry, millennials. Okay. You'll phase out here soon. Okay. So, Andrew, any closing thoughts, and give out your website.
Again, this is CoStar Portfolio Strategy, and we're an affiliate of CoStar Group, so that's just CoStar.com. In general, we do think that the multifamily and just the rental sphere in general is in pretty strong shape. The supply pipeline, that is the number of units under construction, is somewhat worrisome. There's certainly a lot underway, but we think that at the current rate that those have been completing, we've got a little more time.
And when you say the supply pipeline is worrisome, that means not enough supply, right?
I should say that there is quite a lot of luxury product underway. So for that top of the market, that is certainly a risk.
And that I would totally agree with. I can't remember if we talked about that on or off air, but the high-end apartment market, lots of supply, because they've been constructing that like crazy the last several years, right?
They have been, and the vacancy rates reflect that. However, I will say that the stabilized vacancy rate for that luxury product is still quite good. It's still very strong.
Mm-hmm. Good stuff. Andrew, very interesting talking with you. Folks, this stuff is complicated. You've got to peel back the onion and slice it and dice it every which way to really understand the data, and then you're still left with questions. That's just the way it is. So thanks for shedding some light on this, Andrew. Very interesting discussion, and we'll look forward to having you back on in the future.
No problem, Jason. Thanks again for having me.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.